You ever look at the world of finance and just think, how on earth do the pros do it? How do they navigate all that chaos? Well, I'll tell you one thing. It's not a crystal ball. It's a blueprint. And today, we're going to break that fairy playbook down piece by piece.
So what's the real secret sauce? Is it some kind of gut feeling, pure intuition? No way. It's actually a lot simpler and way more powerful than you might think. It really all comes down to a disciplined process. And by the time we're done here, you're going to understand exactly how it works.
All right, here's the game plan for today. We're going to start with the basics, the language of returns. Then we'll dive in and decode the financial markets. After that, we'll get into the fun stuff, building an optimal portfolio. We'll also have to talk about the investor's biggest enemy, their own hidden biases. And finally, we'll put it all together with the professional's blueprint.
Okay, let's dive right in. First things first, before we can build anything, we've got to be speaking the same language, right? How do we even measure success in this game? Well, it all starts with one word, returns.
And right away, we hit something that is absolutely crucial. You've got gross return and net return. Think of gross return as the sticker price. It's the big, flashy number that looks great on paper. But net return, that's what actually hits your bank account after all the fees and expenses are paid. So you've got to focus on the net. I mean, it's your money after all. But listen, returns are only half the story. You also have to ask, what was the ride like to get that return? And that, my friends, is risk. Professionals have a specific way to measure this, standard deviation. The best way to think about it is like turbulence on a flight. A higher standard deviation just means you're in for a much bumpier ride.
Okay, so now we know how to keep score. We're looking at returns and risk. But what are we actually investing in? Well, for that, we need to step into the arena, the financial markets. This is where all the action happens. So inside this arena, you've basically got four main food groups, if you will. You've got your equities or stocks, that's when you own a small piece of a company. Then there's fixed income, which are bonds. Think of them as you loaning money to a company or government. Then you have contracts or derivatives, which get a little more complex. Their value is based on something else. And finally, you have pooled investments, things like mutual funds, which are basically big baskets holding all of the above.
So how does this whole thing actually work? You might picture a chaotic trading floor with people shouting, but really it's a giant, super efficient matching engine. The system, called a limit order book, is constantly lining up buyers and sellers. The price you see on the screen? That's just the exact point where the highest buyer meets the lowest seller. It's like a real-time auction happening millions of times every single second. Kind of cool, right?
All right, now for the main event. We've got the language down, we understand the arena, so the big question is, how do professionals take all these different pieces and combine them to build something powerful, something that actually manages risk while it's going after returns?
Well, the magic word here is diversification. It's an idea you've probably heard a million times, but it is so important. By combining assets that don't all move up and down at the same time in perfect sync, you can actually create a portfolio that is safer than any of its individual parts. It's probably the closest thing to a free lunch you're ever going to find in finance.
Let's actually visualize this so it really clicks. Okay, look here. We've got two different assets. Asset A has a risk level, remember, that's our standard deviation, of 20. And asset B is a bit less bumpy, with a risk level of 12. Now, if you had to guess, what do you think happens when we put them together in one portfolio?
Okay, check this out. Wow.
The combined portfolio has a risk level of just 9. That's not just lower than the risky asset A, it's even lower than the safer asset B on its own. How is that possible? By combining them, we've smoothed out the ride and reduced the overall turbulence. That is the power of diversification right there in front of you.
You know, professionals don't just throw things together and hope for the best. They actually map out all the different possibilities to find the absolute sweet spot. This map is called the efficient frontier. Think of it as a curve that shows you all the best possible portfolios, the ones that give you the most bang for your buck for any given level of risk. A rational investor, they're only going to pick a portfolio that sits on this line.
But then, things get even more interesting. What happens when you add a totally risk-free asset to the mix? You know, like a super safe government bond. Well, it completely changes the game. It creates this new straight line of possibilities, called the capital allocation line, that actually gives you even better risk and return combinations than you could get on the efficient frontier alone. It's a real game changer.
All right, so you could have the most perfect, mathematically sound, genius-level blueprint in the entire world. But there is one wild card, one variable that can throw the whole thing right off the rails. And that variable is you. It's us. Our own minds are just filled with these hidden tripwires, these biases that can totally derail even the best laid plans.
And these biases, they basically come in two flavors. You can think of them as head versus heart. Cognitive errors, that's the head stuff. It's when our thinking is flawed, we make mistakes in reasoning, or we're bad at statistics. Then you've got emotional biases. That's the heart. That's when feelings, impulses, and intuition just completely take over the driver's seat. One is about faulty logic, the other is about overwhelming feelings.
Let me give you a classic example of a cognitive error, the illusion of control bias. This is when we overestimate our ability to control events that are, well, completely uncontrollable. It's the belief that we can somehow steer the ship even when we're really just a passenger along for the ride. It's that feeling that your specific actions can influence a totally random outcome.
And you see this in the real world all the time. I mean, listen to this quote from an executive. "Trust me, my team and I are not going to let those forecasts you're citing come true." I mean, wow, that is a perfect real-world example. It's a statement that just completely dismisses all the external market forces, the economy, competitors, everything. It's based on this pure belief that their team's hard work alone can override reality. That's the illusion of control in its absolute purest form.
Okay, so we've got the tools to measure performance. We understand the arena where it all happens. And we've even faced our own inner demons, those biases that trip us up. So now it's time to put it all together. This is the professional's blueprint.
And the key thing to understand is that this is not a one-and-done decision. It's a cycle, a continuous loop. First, you plan. You create what's called an investment policy statement that lays out all your goals and your tolerance for risk. Then you execute, building the portfolio based on that plan. Then you select the specific investments. And finally, the most important step, feedback. You constantly monitor and rebalance to make sure you stay on track. It's a living, breathing process.
So, if you take away just one thing, let it be this. The crucial point is that professional investing is not about predicting the future. Forget the crystal ball. Forget the hot tips. It is about building a robust framework, a system that is designed to manage uncertainty and achieve your long-term goals, no matter what the future throws at it.
And let's ground this in some real numbers, just to see what this looks like over the long haul. If you look at the period from 1900 all the way to 2017, U.S. equities delivered a real return of about 6.5% per year. Pretty good, right? But here's the catch. It came with a 20% standard deviation. That's our risk, our bumpiness factor. So it just goes to show you that classic trade-off. To get the reward, you have to be willing to handle the risk.
So let's wrap it up. What are the key takeaways from the professional's playbook? It's simple, really. 1. Measure performance with what you actually keep, your net return. 2. Understand risk as volatility. 3. Diversify to smooth out the ride. 4. Be brutally honest about your own psychological biases. And 5. Follow a disciplined process. Stick to the plan. So I'm going to leave you with a question to think about. Now that you have the blueprint, now that you've seen the framework, what's the single biggest bias in your own financial thinking that you need to challenge? Is it overconfidence? Is it fear of losing? Whatever it is, identifying it is the very first step. Challenge that one thing, and you're already well on your way.